everyone. I am Dr. T. Usharani, Assistant Professor from Department of Commerce, Kumaraguru College of Liberal Arts and Science. Unit 4 explores the key concepts of capital structure and cost of capital, which are fundamental to financial management. We will delve into the cardinal principles of capital structure, the concept of trading on equity, and the importance and calculation of cost of capital. Understanding these concepts is essential for companies to make informed financing decisions and ultimately maximize shareholders' value. Introduction to capital structure. Capital structure refers to how a company finances its operation and growth by balancing debt and equity. Each components have a unique impact on a business. Debt is borrowed capital that must be repaid, while equity represents ownership and does not require repayment. The objective of capital structure is to create an optimal mix that minimizes cost while maximizing shareholder value. To better understand this, let's consider an example. Tesla, which has historically relied on equity to fund its growth, because this approach avoids fixed debt payment and allows flexibility in reinvesting profits. On the other hand, General Electric uses a blend of debt and equity, which provides a balanced approach, leveraging debt's lower cost while managing shareholders' dilution. We will take a closer look at optimal capital structure. An optimal capital structure balances the cost of financing with financial risk. This optimal mix varies by company, depending on factors such as market conditions, the company's risk tolerance, growth stage, and profitability. To demonstrate this, let's explore an example. Apple, for example, Apple uses a combination of debt and equity to finance operations despite having a significant cash reserve. This approach lets Apple maintain control and financial flexibility while taking advantage of low interest debt. Conversely, a newer tech company such as a startup in the electric vehicle market might rely more on equity to avoid the financial risk that comes with debt. Cardinal principle of capital structure. Let's focus on cost principle. A firm should aim to minimize the cost of its capital by optimizing the mix of debt and equity. For instance, Microsoft issued a significant amount of debt in recent years, not because it lacked cash, but to take advantage of low interest rates. This reduces the overall cost of capital and boosts returns for shareholders. Moving on to risk principle, which increases debt in the capital structure, raises the firm's financial risk as debt must be repaid regardless of company's profit. An example is real estate companies, which often take on high levels of debts. During economic downturns, this debt becomes challenging to manage as revenue from property sales may decrease, but debt obligations remain fixed. The control principle explains debt financing does not dilute ownership while equity financing does. Many family-owned businesses like Koch Industries prefer debt financing over equity to keep control within the family. This way, they avoid new shareholders, maintaining decision-making power within a closed group. Flexibility principle. Maintaining flexibility principle is essential for a firm to raise funds when opportunities or challenges arise. Consider Netflix, which often raises funds through debt to finance new content development. By maintaining a flexible capital structure, Netflix can adapt quickly to changes in the streaming industry without being overly constrained by financing options. Moving on to the profitability principle, the profitability is maximized when debt is used to a level that optimizes tax benefits without creating excessive financial risk. For instance, companies in a manufacturing sector such as Ford often utilize a mix of debt and equity. Ford leverages debt to reduce taxable income through interest payments while balancing debt's level to ensure profitability which remains stable. We will take a closer look at equity trading on equity. Trading on equity allows companies to use debt to magnify returns for shareholders. When companies borrow at a lower rate than the return they generate, it increases the overall return on equity. This practice can boost profitability, but it also raises financial risk. For example, a retailer like Macy's might borrow at a 4% interest rate to fund expansion, knowing it can potentially generate a 10% return on that investment. The 6% differential enhances shareholder returns. However, during economic slowdowns, this approach could become risky as debt obligations must be met even if sales decline. Let's dive into the next slide to understand the concept of cost of capital. The cost of capital represents the required return on investment to satisfy both debt and equity holders. It's the weighted average of debt and equity cost known as weighted average cost of capital or WACC. For a better understanding, let's start with an example. If Coca-Cola's WACC is 7%, any project or investment that generate more than 7% would add value to the company, while projects that below 7% might decrease shareholders' value. Thus, the cost of capital serves as a benchmark, ensuring that capital is allocated to profits that enhance company value. Turning to the next slide, let's explore cost of debt. The cost of debt reflects the interest rate a company pays on its debt adjusted for tax benefits. Since interest expenses are generally tax deductible, the formula is interest payment divided by net proceeds after tax. It is calculated as the cost of debt times 1 minus the tax rate. Let's take a look at an example to make this clearer. If Amazon borrows at a 5% interest rate and has a 21% corporate tax rate, the effective after tax cost of debt becomes 5%. X minus 0.21 equal to 3.95%. This reduced rate reflects the actual cost of debt after accounting for tax savings, making debt financing attractive for highly profitable companies. Let's move on to the next slide to discuss on cost of equity. Cost of equity is the return required by shareholders, which tends to be higher than debt due to greater associated risk. Two primary methods of calculating it are dividend discount model and capital asset pricing model. Using the dividend discount model, cost of equity is calculated based on dividends and expected growth. For example, if a stock is priced at 100, it pays a $5 dividend and dividends are expected to grow by 4%, the cost of equity is 9%. This model is commonly used for companies with a consistent dividend policy. The capital asset pricing model CAPM calculates the cost of equity based on the risk-free rate, market return and the company's beta. Suppose the risk-free rate is 2%, the market return is 8% and the company's beta is 1.3, the cost of equity in this case would be 10.8%. CAPM is widely used especially for companies whose stock prices are highly sensitive to market movements. Let's take a closer look at weighted average cost of capital. Weighted average cost of capital is the overall cost of capital blending the cost of debt, equity and preference shares according to their proportions in the firm's capital structure. It provides a minimum return threshold for any new investment. Here's an example that can help clarify this concept. If Starbucks has 60% equity with a cost of capital 10%, 30% debt with an after-tax cost of 4% and 10% preferred stock at 7%, the WACC reflects the combined cost of each component. Starbucks would use its WACC as a benchmark for evaluating whether new projects such as opening new stores or developing new products are expected to meet or exceed this return threshold. Let's discuss the key takeaways from this unit. Optimizing capital structure balances cost and risk. First, a well-optimized capital structure finds the right balance between debt and equity to minimize financing cost while carefully managing the financial risk. Each component, debt and equity, has unique costs and benefits. Debt is typically less expensive due to tax deductions on interest, but it comes with fixed repayment obligations, which adds risk. Equity, on the other hand, avoids these fixed obligations but can be more costly and dilute ownership. By choosing the right mix based on the factors like market conditions, growth stage and risk tolerance, a company can strategically use debt and equity to maximize value for shareholders while keeping risk at manageable levels. Cost of capital sets the benchmark for the investments. Next, the cost of capital, especially the WACC, is a critical benchmark for making investment decisions. It represents the minimum return a company needs to achieve on its investments to satisfy both debt holders and shareholders. If a project or investment exceeds the weighted average, it can increase shareholders' value. For example, if a company's weighted average cost of capital is 8% and the potential project has a projected return of 10%, this project would be considered a good investment because it exceeds the cost of capital and will likely contribute positively to the company's growth. This benchmark helps companies allocate resources effectively and make informed decisions about which projects will drive value. The another important takeaway is strategic use of debt, which enhances returns for shareholders through leverage and tax benefits. By using debt, companies can capitalize on the lower cost of borrowing and the tax deductibility of interest payments, which can improve profitability. However, this approach also increases financial obligations as debt must be repaid regardless of profit. For example, trading on equity using debt to boost returns can be highly effective when times are good, but it can also expose a company to significant risk during economic downturns. Therefore, it is essential for companies to assess their risk tolerance and maintain enough flexibility to manage debt obligations even under challenging conditions. Welcome to the assessment. This quiz is designed to evaluate your understanding of key concepts on capital structure and cost of capital. It contains 10 multiple questions, each with 4 options. Please take a moment to review each question carefully and select the most accurate answer. Best of luck. In conclusion, a well-chosen capital structure and a clear understanding of the cost of capital are fundamental for maximizing shareholder value and managing financial risk. The right balance of debt and equity can reduce financing costs, support company growth and provide flexibility for future opportunities. Thank you for your attention.